The Japanese stock market has suffered its most significant drop since 1987, an event that shook the financial world more than 35 years ago. This crash has left many investors stunned and raises a troubling question. Could Japan, one of the world's largest and most advanced economies, go bankrupt? In this video, we're going to analyze the factors that have led to this situation and the potential consequences that the global economy could face. To better understand the context, it's essential to remember that Japan has faced significant economic challenges over the past few decades. After the burst of the real estate and stock market bubble in the late 1980s, the country entered a prolonged period of stagnation known as the Lost Decade, which eventually extended over 20 years. To combat deflation and stimulate the economy, the Bank of Japan adopted extremely loose monetary policies, including near-zero interest rates and massive asset purchase programs. While these measures have kept the economy afloat, they have also created serious vulnerabilities, such as a public debt that currently exceeds 250% of GDP, one of the highest in the world. In recent years, a particular investment strategy has become popular on Wall Street: borrowing in Japanese yen and investing in U.S. assets. This phenomenon is largely due to the divergent interest rate environment between Japan and the United States. While the Federal Reserve has raised interest rates in the U.S. to 5.5% to combat inflation, the Bank of Japan has kept rates in negative territory to stimulate its economy. This 5.6 percentage point differential between the two currencies has created an opportunity for what is known as a carry trade. U.S. investors, taking advantage of the extremely low rates in Japan, would borrow in yen at an interest rate as low as 0.1% and invest those funds in leading tech companies like Alphabet, Meta, Tesla, and Nvidia. This way, they could secure significant returns not only from the interest rate differential, but also from the consistent depreciation of the yen against the dollar. Over the past 4 years, the yen has depreciated by 34% against the dollar, which has further boosted the profits from this strategy. However, this type of investment, although initially lucrative, carries inherent risks. One of the main dangers is that it tends to inflate financial bubbles. Every time an investor borrowed in yen, it further weakened the Japanese currency, creating a spiral where the expectation of further yen depreciation fueled demand for this strategy, accelerating the carry trade and making it even more profitable. However, this cycle was broken on July 31st, when Kazuo Ueda, the newly appointed governor of the Bank of Japan, surprised the markets by raising interest rates from 0% to 0.25%. This move, although modest, triggered panic in the Japanese stock market, which saw its most significant drop since 1987. The Nikkei 225 index plummeted 15% in just 2 days, and iconic companies like Shogo saw their shares plunge by 16% in the same period. The panic was not confined to Japan. Quickly, fears spread to U.S. markets, where major stock indices, particularly tech stocks, also suffered significant drops. The concern centered around the possibility that the interest rate differential between the yen and the dollar would narrow, making the carry trade strategy less attractive. Currently, the market is speculating that the Federal Reserve might cut rates by 0.75 percentage points, while the Bank of Japan could raise them by another 0.25 points. If these predictions come true, by the end of the year, the interest rate differential between the dollar and the yen could shrink from the current 5.6% to 4%, completely changing the landscape for investors. Given this new scenario, the profitability of the carry trade has dropped significantly, and the demand for the Japanese currency to issue debt has declined. This has led to a squeeze-out, where the yen has appreciated by 10% in just a few weeks, causing bankruptcies and multimillion-dollar losses in investments that depended on the yen's depreciation. Currently, the outlook is bleak. The Japanese stock market is expected to continue falling, and this trend could potentially drag down the U.S. stock market, given the interconnectedness of global markets. However, one crucial question remains. How high can Japan raise interest rates without triggering an even greater crisis? Japan is a country with public debt that amounts to 250% of its GDP, which equates to approximately 13 million yen per capita. If interest rates were to rise to 5%, And considering that Japan's tax revenues have barely increased in recent years, it would be nearly impossible for the Japanese government to repay all its debt solely through tax contributions from its citizens. At this point, the Japanese government would have only one option left: devalue the yen. However, this option is highly problematic, as interest rates were raised precisely to prevent further devaluation of the yen, which, as we've seen, has already dropped by 34% over the past 4 years. Japan is caught between a rock and a hard place. If it continues to raise rates, it could trigger an even greater stock market collapse than the one seen during the 1980 bubble. On the other hand, if it fails to meet its financial obligations through citizens' contributions, it will have no choice but to devalue the yen, potentially impoverishing its citizens by reducing their purchasing power. In summary, Japan is in an extremely delicate situation, with few viable options and many uncertainties about the future. What will happen next? Will Japan go bankrupt? Will the yen continue to devalue, affecting millions of people? The future is uncertain, but one thing is for sure: the coming months will be critical for the Japanese economy and, potentially, for global financial stability. Thanks for watching this video. Don't forget to subscribe for more content like this, and leave your thoughts in the comments below about what you think could happen. See you in the next video.